Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading economic and financial developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, US President Donald Trump has reignited trade tensions with one of America's closest allies, threatening to impose a 35% tariff on certain Canadian goods beginning the 1st of next month, August. The move marks a sharp escalation in the US president's trade rhetoric and raises fresh concerns for financial markets and global trading relationships. The proposed tariff, which was announced Thursday evening local time, represents a significant increase from the existing 25% levy on US imports from Canada not covered under the US-Mexico-Canada Agreement, USMCA. Most Canadian exports to the US are currently exempt under that deal, and those exclusions are expected to remain. However, the announcement signals Trump's willingness to override existing agreements to pursue what he views as more favorable trade terms. Quote, "Fentanyl is hardly the only challenge we have with Canada," end quote, Trump wrote in a letter to Canadian Prime Minister Mark Carney, which was posted on social media. He cited various tariff and non-tariff barriers that he claims contribute to an, quote, "unsustainable trade deficit," end quote, with the United States. The president's stance has rattled markets. US stock futures slipped, while the dollar strengthened against the Canadian dollar, jumping 0.6% after Trump's post before easing back. Although the proposed tariff would spare USMCA-compliant goods, the threat is significant for sectors not protected by the agreement. Key materials like steel and aluminium, already subject to a 50% tariff, would not be affected by the new rate, though energy-related imports may continue to benefit from the much lower 10% tariff rate, according to US officials. Trump's trade actions have already had concrete consequences. Canada's top diplomat, the foreign minister, said on Thursday that Ottawa is intensifying efforts to diversify trade and finalize a free trade agreement with the Association of Southeast Asian Nations. Quote, "We're engaged in complex negotiations with the United States to address these tariffs," end quote, she added, while criticizing the levies as, quote, "unjustified," end quote. Even with free trade agreements with players like Southeast Asian nations, this of course will not be able to replace the size and dynamism of the US market. The Canadian industry minister called Trump's move, quote, "a big shock," end quote, particularly following recent US threats to impose a 50% tariff on Canadian copper, of which Canada is a major supplier. Though there is some movement at the Canadian border, US data shows that fentanyl trafficking is overwhelmingly linked to shipments from Mexico and China. Nevertheless, Trump indicated he might consider modifying the tariff threat if Canada increased its cooperation in counter-narcotics efforts. Industry groups and analysts are sounding the alarm. Quote, "It indicates how volatile these negotiations are," end quote, said Canada's Automotive Parts Manufacturers Association. The proposed tariffs would preserve trade flows in tightly integrated sectors like autos, where Canada remains a vital export market for US-made vehicles. Canada, meanwhile, continues to explore options for expanding its export capacity to Asia. Major investments in energy infrastructure, such as the Trans Mountain Pipeline and new LNG facilities, signal a strategic shift to reduce reliance on US markets. Still, nearly 75% of Canadian exports, particularly oil, gas, and autos, head to the United States. Next up, the Association of Southeast Asian Nations, or ASEAN, foreign ministers have reaffirmed their commitment to deepening ties with China, as rising geopolitical tensions and looming US tariffs cast a shadow over regional stability. Meeting in Kuala Lumpur on Thursday of this week, yesterday, the ministers emphasized the strength and mutual benefit of their relationship with Beijing. Malaysia's foreign minister declared China as, quote, "one of ASEAN's top substantive and dynamic partnerships," end quote, founded on, quote, "mutual trust, shared interest, and growing economic interdependence," end quote. China's top diplomat and foreign minister Wang Yi echoed this sentiment, underscoring China's commitment to ASEAN as a regional diplomatic priority and partner in shaping a global order based on shared prosperity, to use his words. The reaffirmation of the ASEAN-China ties comes just weeks after the unveiling of an ASEAN-China Free Trade Area, ACFTA 3.0, a major upgrade covering digital trade, green economy, and supply chain connectivity. Bilateral trade between the two sides reached $770.9 billion in 2024, maintaining their status as each other's largest trading partners. The show of solidarity also reflects ASEAN's unease over newly announced US reciprocal tariffs to take effect on the 1st of August, which we've discussed earlier this week. The rates range from 40% on imports from Myanmar and Laos to 20% 30% on Vietnam and the Philippines. Malaysia, a key US trade partner, faces a 25% tariff. Singapore's revised rate is still pending. During a closed-door session with the US Secretary of State Marco Rubio, ASEAN ministers raised concerns about the tariffs, though Rubio declined to respond directly, instead affirming Washington's long-term commitment to the region. Malaysian Prime Minister Anwar Ibrahim warned that trade is becoming weaponized in a new era of geopolitical rivalry. ASEAN's draft joint communique calls unilateral tariffs, quote, unproductive, end quote, warning they risk deepening global fragmentation. Despite strong trade ties, concerns persist. Analysts note that the ACFTA 3.0 could reinforce ASEAN's economic dependence on China or open the door to import surges that threaten domestic industries. Meanwhile, tensions in the South China Sea remain unresolved, with the long-delayed Code of Conduct now postponed to 2026. Despite these defiant noises coming from Kuala Lumpur too, the fact remains that the US offers the most attractive consumer market in the world. With China itself grappling with overcapacity issues, it simply cannot replace the United States, and these Southeast Asian nations know this. If you want to be on top of the most up-to-date analysis on the biggest moves in the most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. Next up, and finally for today, the United Kingdom faces mounting risks to its fiscal stability, with the Independent Office for Budget Responsibility, OBR, warning that soaring debt levels are severely limiting the country's ability to respond to future economic shocks. In its latest Fiscal Risks and Sustainability report published this week, the watchdog said public debt is now at its highest levels since the early 1960s and still rising, driven by weak growth and elevated interest rates. The OBR said recent attempts to put the UK's finances on a more stable path have delivered only, quote, limited and temporary, end quote, progress. As a result, the country is increasingly vulnerable compared to its peers. The UK now ranks 6th among advanced economies for total debt, 5th for its budget deficit, and 3rd for borrowing costs. Financial markets reacted to the report with concern. The pound fell as much as 0.6% against the dollar, while investors sold UK government bonds, pushing 10-year yields up to 4.63%. which is, frankly, very high. The OBR noted that the borrowing costs are now higher than at any point since the early 2000s, adding pressure to an already stretched fiscal outlook. Chancellor Rachel Reeves is facing growing calls to raise taxes in the autumn budget, as projections point to a potential £20 billion gap requiring either revenue increases or spending cuts. U-turns on welfare reform and broader economic stagnation are weighing on the government's room to manoeuvre. The long-term outlook is also grim. Public spending on pensions is expected to rise sharply from 5% of GDP today to 7.7% by the early 2070s, largely due to the triple lock, which guarantees increases in the state pension in line with inflation, wage growth, or 2.5%, whichever is higher. The OBR estimates that the triple lock will cost nearly 3 times more than originally forecast by 2029 through 30. Additional pressures loom from climate-related costs, that is to say, government policies tied to climate change concerns, rising defence spending, and global geopolitical instability. The UK's ageing population and the declining role of domestic pension funds in the bond market will also complicate debt management, with overseas investors likely to demand higher returns. A key near-term risk is sluggish productivity growth too. The OBR's forecasts assume productivity growth of 1.25% by the end of the decade, considerably more optimistic than the Bank of England's 0.75% projection. Incredibly, even a 0.1 percentage point downgrade would eliminate Reeves's £9.9 billion of fiscal headroom. The Treasury acknowledged the challenges, stating it remained committed to fiscal rules and long-term economic renewal. But as the OBR makes clear, without significant policy adjustments, the UK's ability to weather future shocks will remain dangerously constrained. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Friday, have a restful weekend, and I will see you for a new week of updates on Monday.